everyone, welcome back to Yuri's Box. In today's video, I'm going to talk about credit spreads and small cap stocks. If you like this kind of content, consider leaving a like. And as usual, nothing in this video is financial advice. So, if you haven't seen my previous videos, I'll start off by really giving a brief explanation of what you should think whenever you hear credit spreads. And in this instance, when we're talking about credit spreads, and when you see this number here on the chart, what you have to think is premium. And when thinking premium, you have to imagine extra yield that investors are demanding. And why are they demanding extra yield? And on top of what? So the chart that you have in front of your eyes right now is basically a comparison between a treasury bond, so say something along the curve of the treasury, again the treasury bonds, and a double B or triple B corporate bond. And this chart is measuring them at equal maturity. So take, for example, the 10-year bond treasury, and you're comparing it with a corporate bond that has a maturity of 10 years. And it's basically measuring how wide is the spread between what the 10-year bond, a treasury bond, is offering and what the corporate bond is offering. And the idea is that these triple B rated bonds by nature have an extra yield on top of the treasury bond, for the simple reason that a treasury is risk-free. Now, we can debate all day about, how risk-free our treasuries, given, the political turmoil. But as far as the comparison is concerned between a treasury bond and a corporate bond, you don't have to deal with the heightened bankruptcy risk. And that is really what the spread is measuring. Whenever you see the spread at cycle lows, like we saw from really November of 2024 up till a little while ago in February of this year, right here, that is the market's way of telling you that investors are demanding less premium, all right? They're demanding less extra yield on top of, the treasury bond, because bankruptcy risk is perceived to be low. All right. Now, this is really just a really simplification of things, just to keep things simple, because I think it's the best way to understand things. So again, whenever you see the spread, this number you see right here, be at cycle lows, you can interpret that as investors really being complacent, if you're a glass half empty kind of guy. Or really, if you're a glass half full, you can see it as things are great, all right? Because bankruptcy risk is perceived to be low, the economy is doing fine. So I don't really have to go and demand more yield, all right? I don't have to get compensated for, heightened risk, and that risk being I'm not going to get paid back potentially, okay? So whenever you see the spread be at cycle lows or in any case declining, that is an indication that investors in the market are expecting things to be just fine. The economy is doing just fine, and there's no reason to be, I'll be happy as an investor with less yield because I don't have to get compensated for potential of bankruptcy. If, on the other hand, you're seeing credit spreads start to widen, now, again, this might seem quite dramatic, all right? We've gone from 2.6 to about 3.5 on the chart. And that might seem, at a glance, wow, things are really starting to move. But in the context of history, let me put this on a weekly so, I can drive the point home. You can really see that we are far away from high levels of stress. Okay, because if we were really in, things being Armageddon, all right, you'd see credit spreads well above, at the very least, 4.5 at the very least, um, which seems to be historically at least the level where things seem to tip over into something else. But again, we are well above the highs seen, for example, in the early 2000s when credit spreads were about at 10%, let alone 2008 when we saw credit spreads at 21. Or again, whenever you see these spikes, I mean, that is a symptom of stress in the system, all right? So as far as things are concerned, yes, credit spreads have widened a bit, but it's still nothing too dramatic. Now, how could you use this, all right? And I'll explain, and this is really an update on how credit spreads are acting in relation to small cap stocks. The way you can visualize things is take small cap stocks, all right, and you can use them as a proxy for the performance of the companies that are trying to issue that low rated those low rated corporate bonds. And you can really paint a picture where, one of them is kind of lying. And why would that be? Because if credit spreads are low, as they have been for quite some time, that means that bankruptcy risk is perceived to be low. And if bankruptcy risk is perceived to be low, then the stocks of the companies that are trying to issue that debt should be doing fairly well. And you might argue that what we've seen right here, all right, from October 2023 up until now, was exactly that, stocks doing fairly well of these companies that we're talking about. But you have to put that in the right context, and the right context is that if you look at, for example, what the S&P has done ever since the that low in October, ignoring the recent low, ignoring the recent lows, the S&P went up 50% after the low in 2023. If you look at the Russell 2000 from that point on, again, it's the same thing, but ever since the 2021 high, we're flat, exactly flat. And if you keep in mind the recent lows were actually 20% down. On the other hand, if you go and look at the S&P 500, ever since the 2021 high, the 2021 high, we're still 27% up. Contrasting, in contrast, Russell 2000 is flat at best. And if you consider these recent lows, we're still 15% up above the 2021 highs. So it depends really on how you look at things. If you look at from the 2023 low, then yeah, everything is doing, as expected. But in the context of the 2021 high, there seems to be some kind of underperformance that needs to be addressed on the small cap stocks. Because again, coming back to credit spreads, if risk is perceived to be low, then why haven't small cap stocks really performed even more? So again, the question that needs to be asked is, or the question that needs to be answered, is who is telling the right story? Because if credit spreads are right in being low, then you would expect small cap stocks to have clear skies ahead and outperform. But not only have we seen, ever since the 2021 highs, things be flat at best. And if the stocks are correct, in underperforming ever since 2021, well, then credit spreads are misplaced. And credit spreads have to, they have to widen significantly. Now, granted, what the movement that we've seen since the first weeks of February, a lot of it came with, the government policies. All right. Now, there is a thesis here with small cap stocks that, given the fact that they are less exposed less to the international market, they are probably more insulated compared to, say, your mega caps. And so they could actually outperform. However, if we are to enter, as we move closer towards the summer, a period of time where maybe the economy slows down, you could easily suggest that small caps have more to lose. All right. So again, it's just a matter of paying attention. Look at credit spreads and look at the small caps. Look at the Russell 2000. So far, I think I made my last video on 17th of March, right here. And on the 17th of March, credit spreads were right here. So we've seen some widening, but it's still nothing too dramatic, okay? So, as I've said many, many times, I think it is an evolving story. Of course, today is April 2nd. We'll have President Trump address, really have the tariff announcement. And I think this is the first stepping stone, into answering who is right or correct, potentially in this, comparison between credit spreads and small cap stocks. And really the only thing you can do is wait and see how the economic data plays out. One thing I will say, and it is the reason why I say it is an evolving story, because so far as the economic data is concerned, we have had the so-called soft data point towards a worsening of conditions. However, the hard data, and again, the soft data being something like surveys, I've looked at ISM, I've looked at the PMIs, I've looked at many things. But on the other hand, the hard data, think about non-farm payrolls, think about the unemployment rate, think about jolts, think about like that. That part of the data still hasn't rolled over. But the thing is, I still think that to declare victory right now would be premature, given the fact that not only have the pandemic era stimulus really worn out, probably. On top of that, we still haven't had the good news, meaning the tax cuts. We still haven't talked about tax cuts. We haven't talked about the deregulation, and it's April. And on top of that, we have tariff talk and some degree of fiscal tightening. All right. And those are both growth negative. And as long as we are in that environment, I would be very cautious to declare victory. And I would follow the credit spreads to see, who is right, potentially, in, between small cap stocks and credit spreads. If small cap stocks are correct and underperforming ever since 2021, then credit spreads have to widen. And that would signal economic conditions worsening. But if, on the other hand, credit spreads have been correct so far and being so narrow, well, then you should expect small caps to eventually, go on their merry way from here on out. But again, that's just something that will need to be answered in the near future. So again, one of them has to be correct. We ever since I made my last video, we have seen some widening of credit spreads, but it's still nothing too dramatic, really. If you look at history and zoom out, I mean, we're just revisiting the lows of 2018 cycle, um, and yeah, parts of 06, 08 cycle. So again, it's an evolving story. Keep an eye on economic data, and especially tonight's Trump announcements. All right. So I'll keep it at that. And if you like this kind of content, consider leaving a like. And I'll see you next time. Bye.